Wes, I was actually quite interested to find out your take on the best business structures for this, particularly if we're looking at accumulating some assets or some savings and trying to minimise tax. And I was, just interested to get some advice on how you would suggest setting a business structure up to reduce the amount of tax that you're paying and be able to save as well as purchase assets more effectively.
Great. All right. Well, without knowing all of the situation, and what you do and don't have, I have to say that what I'm going to say is kind of general. But ultimately, I think the best structure is to own very little in your own name. In an ever-advancing litigious world, then especially in business, you don't want to leave your hard-earned assets open for the taking. So, the most obvious structure, because you can go completely overboard and just spend too much money on accounting fees. The most obvious structure is to have a company and a trustee for a trust. So maybe a family trust that has a business as a trustee. What that means is that if somebody was to sue you, they're not suing you, they're suing the company, and it means all the IP is held in trust, so it can't be sued. So what that does is it removes you personally from because their interaction is with the business. Obviously, you can have insurances and things like that in between the business and the customer as well to limit those things, and that's a good idea. And then if I were you, I would have another trust that's not the trust that is your family trust, and I would put real estate and other holdings in that as just a holdings trust that doesn't trade, for the sole purpose of you are once again another entity removed. And that trust will just build and build and build and build and build and build and build over the rest of your life, and you'll probably pass that trust on with all its asset holdings to the next generation and keep going from there. So, there is a little bit of accounting fees in amongst that structure, more than if you were to just be a sole trader. You're probably taking your accounting fees from $1,000 a year to, I don't know, 6 or something. That to answer your question of how to best protect yourself when you have assets, that would be the most obvious way. You'd have to take into consideration a whole bunch of little issues, which your accountant or lawyer will do, but that's typically how I would set it up.
Yep, no, that's great. Whereas the other thing is as well, what's your opinion on using a self-managed super fund for purchasing assets and those kinds of things?
So I'm not a fan of superannuation. I've said that on the show. That's not true. I'm only not a fan of it for me. It's a great investment tool for somebody who's 55 or something like that and wants to use it. So self-managed super would probably be, in my eyes, a better version than superannuation, because at least you get to have a say on where your investments go. I really like the idea of using self-managed super fund to buy maybe your office or your work premises or assets like that. The only concern for me is the trade-off is you have to wait so long. You have to wait so long to be able to access the gains, right? So, the real estate that I bought in 2008, I could liquidate right now and keep all the money and don't have to ask anybody permission to do anything. The tenant paid them off and life's good. Whereas you are restricted in super on what you can and can't do. So that concerns me a little bit, that if you're young, then it's a long way between now and when you get to access your money, and you would hate to be financially okay at 50, but you can't touch it for another 7 years. I think that would be a bit of a shame. So it's definitely got some reasons to do it. Me personally, I won't be doing it because I would rather immediacy and be able to juggle and take advantage of things, and self-managed super is too restrictive. Having said that, I don't need to be putting money aside for retirement, so that's the trade-off.
Yep, no, that's super. And the other thing I was just going to run past you as well was in regards to property as well as shares. Would you buy those to trade and turn them over, or would you sort of buy them and hold on to them just to get more capital growth?
So I think if you do share market trading as a business every day, then that's fine. You do it as a business, and you watch it, and you've got the time, and you've got 50 hours a week to monitor. If you run a business, you don't have the time to do this. So to me, it's a buy and hold strategy. I don't want the pressure of ups and downs in my life, and I'm just looking at building assets for the long term. So for me, all my real estate is buy and hold. I literally expect my kids to bulldoze those houses and put new ones up. That's how long I intend to keep them. In terms of share trading, you know, I mean, go and read The Intelligent Investor, and you'll fully learn how to do share trading by Benjamin Graham. It's a phenomenal book, and the way I look at it is, I'm only buying shares because I want to actually own part of the company. I'm not buying shares to do a quick deal, and I only want to buy the company because I like it and I like their products and I think they're going to go up. And then the way I look at this is, you know, I'll just pick a company, right? Let's say BHP. Maybe that's not a great example. Their yields are pretty low, but let's say BHP shares. I would buy and hold for the long term. And what I would do is every time there's a dip and they go down, I buy some more and then hedge and then, you know, keep them for a bit longer. And then, you know, whatever happens. And then next time there's a little dip on their radar, go buy some more. And that way it will explode over a period of a life. It'll be absolutely ridiculous what you would end up with.